the question on how do you identify a startup that's trying to change an industry, I think there are two perspectives to it. One is to try and see that is there a startup that is trying to solve a real problem that is out there, and they're trying to solve it at scale. The other way to look at it is some startups are trying to solve a problem which the customer doesn't even know that it exists. And then it is basically about behavior change. Case in point is, say, Zomato. None of us even knew that we actually wanted food delivery so quickly, or we wanted so many options. The difference between what happens in the first case, where there is a real problem and the startup is trying to change it, versus actually trying to solve a problem that the customer doesn't even know, difference primarily is the amount of money it's going to take for you to build a real business, because the second one will actually require a lot of money being pumped in for investor education and marketing. So these are the two ways that one looks at it. Of course, both of these, for a startup to be able to scale, the idea needs to have depth. So it cannot be something that is solving a very small or a niche problem. And then even if you're trying to put in a lot of dollars behind it, it will still not be able to reach a certain level. So that's the first question answered. The second question on the same bit is on saying that how do we identify startups that we want to invest in? Now, let me just step back a little bit on this. We are a platform. So what we do is that our job is to make sure that if there is a startup that is doing innovative, niche, fabulous things, we will try and bring it onto our platform. Having said that, our curation on the platform is less than 1%. So just to give you a sense of numbers, last year we saw about 7,500 companies, of which only about 150 companies were actually shortlisted and curated to be shown to our 700 investors. And only 56 of them actually got invested. Now, what do we do to get the 7,500 to the 150 before we take it to our investors? Now, of course, there is this whole set of very, very talented individuals in our investment team. We have a team of about 20 people who are doing just this day in, day out. What we have recently started putting in place is our own proprietary algorithm. Now, this algorithm is actually the first voice on the table. So what it does is that whenever we look at a startup, when it comes and applies to us, or we have approached it, it can be, in various different ways. This algorithm basically is a crux of all our understanding of, our 15 years of investing of companies that we have maybe not invested in, and more importantly, the 200 companies that we have invested in. So we try and find those common threads and those common parameters that have actually ensured that a company is either doing well or has a potential of either doing well or it doesn't do well. So like I said, it has about 100 different parameters, but some which are very, very critical that we have increasingly started looking at, of course, is the founder pedigree. Is there complementary skills that is out there? Are they solving a real problem? What is the regulatory environment? What is the competitive environment? More importantly, if it is a consumer business, is there enough traction? If it's a B2B business, do you have the right beta customers? And of course, there are these various financial parameters that we would look at in terms of, is there leverage in the company? What are the earlier investors? Who are the current investors that are coming in? So, to summarize all this, it is not one or two things that we look at when we try to identify a company, but an amalgamation and a synthesis of all these various parameters that I spoke of. Now, the question on saying that what do we look at in a founding team before we invest in them? See, this question has now actually started giving us very different answers today than they gave, say, even 5 years back or even 3 years back. Cut to 5 years back, if a founder just came from a Ivy League or the top, some IIT IIMs in India, their probability of getting funded was much higher than somebody else. Today, as the Indian ecosystem has matured, we are seeing a wide range of founders who are getting funded. And what has now started driving founder interest or investor interest in founders is primarily our bet or our algorithm or our synthesis on saying, will this founder or this founding team be able to deliver over the next 4 to 5 years? When you start asking this question rather than just the passion or the excitement, which of course is very, very critical, you start seeing that there are these other parameters that have started becoming very important. So, for example, if you are looking at, say, fintech, chances are that a founding team will require some earlier experience in financial services to be able to get funding. Second is, we have also started seeing that a lot of founders are now the second level of funded companies. So, you will find that Myntra, Snapdeal, Flipkart, Ola, all these guys, the CTO, CMO, CFO, have started coming out and they have started floating their own companies. That's the other founder that we're very, very excited about. Of course, the other founder that we're really excited about is somebody starting their second or the third venture. Absolutely critical. And second or third doesn't always mean second or third successful ventures. We are also talking of founders who have failed, because then they know what not to do. So these are a couple of very important questions around it. To the question on saying that how do founders actually build in a team where the skill sets don't exist? In my view, that's actually one of the most critical places where investors' money should be used immediately. So a difference between a company that is bootstrapped or it has just started out, and you have a founder who's a founder and a CEO. I think the difference between that and a funded company is actually in the verb of saying, are you a doer CEO or are you being a CEO? So what is the difference between the two? When you don't have money and you're building it on your own, you have to do everything and you have to ensure that you're building a very, very lean company. The minute you have funding, the successful founder or the successful CEO is the one who is being able to step back and then actually identify saying, what are the critical skill sets that are required? Not what I have, but what is required for me to scale up and build the company. And those are the skill sets that you have to immediately identify and hire for. Now, how will you actually excite somebody to come and join you? Couple of things. One, of course, is you have to ensure that you're incentivizing people in a very good way. Now, when I say incentivize, it is not just about the fixed salary. It is about showing them the path to wealth. So, a very good question that you can sometimes ask somebody when they join you is to say, how much wealth are you wanting to create for yourself when you join this company? And then try and see if there is a way for you to be able to match that number in the way of not just fixed, but ESOPs and variables and performance bonuses. The other very critical thing why people join a startup is the ability to be able to make mistakes. You have to find the best people, give them the broad canvas, and then let them just be. Be okay with mistakes, be okay with less than 100% perfection. Because both of these things do not go with supernatural growth or exponential growth. To the question on saying what are the factors on which a startup should actually quantify the amount of funding that they're looking for. Now, this is going to come very, very strange from somebody who's in the business of funding companies on an ongoing basis. But a founder should be absolutely sure that they actually need funding at this point of time. And they're not just doing it because it is cool to do so, or it is cool to go out there and say that I was valued at a certain number. You need to be absolutely clear that I want that money. And how will you be clear? You should be able to be quantify in your head first, even before you ask the investors, on what are you going to do with that money. So how are you going to use that money? Number one. How much are you going to be able to grow with that money? So there should be a with or without money growth path for you. And you should be at a place where you say, if I don't raise this money, I'm not going to be able to compete, or I'm going to grow at a subnormal pace. subnormal pace. That is the time when you go out and raise money. So, absolute surety that you need money. Secondly, defining what is the quantum for the next 3 to 4 years. Third, and the most important one, is how much are you willing to dilute at this point of time? The question at most of these negotiation tables is not on saying how much money is available on the other side. It is more a question of saying how much you as a founder are willing to dilute at this point. So, like a rule of thumb, if you're raising your first level of money and you're getting diluted anywhere below 60%, I think you have a problem there. So the founding team needs to be at least 60% after the first round of funding, so that as you move into the various rounds of funding, you are at least at a 20% when you have got the company to a scale and we are willing to sell out or go IPO. Yeah, the due diligence process for as we follow in Mumbai Angels. So of course, I think there is one level of due diligence which is even before we bring the company to our investor base. Then there is a due diligence process once investors say yes, we are interested, we are prima facie interested. So what are the things that we do before we bring them to our investors? So of course, like I mentioned earlier, there will be this whole algorithm, which is basically not so much due diligence as it is more an curation process on saying, does this look like a fundable idea? Now, at that point, once you say, yes, this looks like a fundable idea, we are going to float it to our investors. Once the investors say, yes, this looks interesting, if you guys come back to us and say, the due diligence is looking good, is when we start looking at these couple of things. So one, of course, is the legal due diligence. Legal due diligence basically means, is your house in order? Do you have all the documentations done? Is the filings all done? Do you have any legal cases pending against you, either as a company or as a founder? Are there, sister companies or are you a subsidiary of companies that? So basically, are you legally absolutely in the clear? So that's number one. And what you need to know is that at the place where we do investments, if there is even a slight legal if the due diligence comes unclear, chances are that we will drop the deal, because these companies are so nascent that if they have legal problems at that level, chances are they are only going to increase as they grow. So that's number one. The second, of course, is the financial due diligence on saying, the claims that you have made, your numbers, have you done your filings properly? Are your numbers looking clean? Are there things that you have mentioned but are not showing in your books? Vice versa, are there a lot of claims lying on your books? You have a lot of liabilities. One of the key things that we as investors don't like is founders' loan. So one of the first things that we will ask you to do is convert that loan to equity. Then also, are there sister companies that have given loans? So loan is something that we at the level where we invest, we are not very comfortable with. So those are the other things that we look at. The third very big thing that we do is what is called claims validation. So basically, most of the companies that we are looking at funding at our stage, they would have some customer interaction, they would have some sales done, some, if you say, for example, if you're a health tech company or a med tech company, you would have had some clinical trials, some working with some hospitals. If you are, say, an IT company, you would have some beta customers. So we would go back to you to ensure that you furnish enough documentation for us to be able to say, yes, the claims that you made are validated. Then, of course, there is this whole piece on founder validation. So we are going to do a background check on the founder and the founding team to make sure that, there would be no surprises that come up both in terms of legal, financial, if there are any cases pending against you. So these are the 3 or 4 things that one does in the due diligence, and it normally takes a couple of weeks from the time that we would start the process to when this ends. Are there any specific sectors in which Mumbai Angels is looking to invest? Now, like I mentioned early on, we are a sector agnostic platform. Our job is to ensure that we bring in the best deals that are there out there for our investors to be able to invest in. So, we have a global investor base of about 700 people, of which about 12 to 15% are from outside India and the rest are from India. And the only thing that they are looking for is to say, please ensure that if there is a good deal out there in the market, we should be able to participate in it. So that is number one. The second thing that you need to look at is that we also continuously keep checking with our investors on saying what is it that is catching their fancy. So we will also try and bring some of those deals. And third, of course, is we are just because of the stage where we are being able to catch niche trends earlier on than say most VCs do in the market. Some sectors that I think will be looking very exciting for us this year, apart from the 24-25 sectors that we keep investing in, of course, are agri-tech, defense tech, space tech, ESG, clean energy. And I would love to do stuff around Web3, but we are still yet to see a lot of exciting companies come up there. But whatever gets encompassed in what is called Web3, in terms of blockchains, artificial intelligence, trying to bring cryptocurrencies, trying to bring NFTs, virtual worlds, anything around that full gamut. But yeah, these are the 7-8 sectors that we think will have a lot of excitement going on in the next year.